Good morning, everyone. Happy 4th of July, Independence Day. What an awesome celebration, I suppose, is going on in the US and so on. Have a wonderful day. I'm going to have a look at a few chart setups that have just caught my interest over the last couple of days. So let's go through them. Let's start with natural gas, and we've got the 4-hour chart up on here. We're still long from $2.65, but what I'm looking for on this chart, you can see we're still within this channel. We've just fallen back down to that support level at around about 265, more or less where we got in. But what I'm looking for, and I put a tweet up on this, I don't have this drawn in on my chart at the moment. I'm not going to redraw it now, but you can see these green circles. These are spike lows or wick lows on the 4-hour chart. And you can see that these are a really good indication that the chart is about to reverse, that the price is about to reverse upwards. We're trading this long, so we're looking for spike lows. Whenever you see these spike lows that I've circled in green, you can see that the price begins to move up. We don't have one at the moment. Actually, this is an older chart that I put up. So let's have a look at the current chart and go across back to the live charts. You can see I've taken all the green circles off here, but you can see that this 4-hour candle is beginning to form what might actually be a wick low. So we're going to keep an eye on that. If you're not long on natural gas already, you might like to look for that spike low to occur on this 4-hour candle, which rolls over in about an hour's time, the time I'm making this video. So we're looking for something along the lines of these previous wick lows. That would indicate good buying pressure at support underneath us, and hopefully then we'll see the price drive upwards through these moving averages. That's the 20 and the 50. We're aiming for the top of this channel, and then beyond that we're aiming to get through this gap between $2.88, $2.90 and $3, where I'll be looking to exit the long trade and decide what to do next. Sorry to interrupt your video. I hardly ever do this, but I'd really appreciate it if you subscribe to this channel and press the like button and share it with your friends. And it also encourages the YouTube algorithm to promote this video so that more people get to watch it. So we're looking for one of these spike lows or wick lows that we see repeatedly on the natural gas chart. Natural gas is one that you can quite confidently trade when you see these spikes or wicks, and they also occur from the top side. So when we're trading this short, you can see where these spikes or wicks happen at the top against resistance here. In this case, we've got the two moving averages, the 20 and the 50, and that previous resistance Fibonacci level. If we go back, you can see that double top there. It's a sort of a tweezer top. There's one over there. So they're pretty reliable in terms of trading natural gas. You can see repeated wick tops here at the highs. You can see a wick low there, a wick low there, a wick low there, and so on and so forth. Wait for the 4-hour candle to close, wait for a wick formation, and if it's in the direction that you're trading and we're against support or resistance, depending on the way you're trading, you can enter a trade with a bit more confidence than you would normally without seeing one of those spikes. So that's one interesting thing I've seen on the charts today. Just having a look at these other commodities, we've got soya spiking up into that resistance zone. I think we might get a little bit higher on soya and possibly even sugar, with heat waves and potential droughts and dry conditions going across various parts of Northern America and other parts of the world. So we might see soya and sugar driving up a little bit higher, and we may get an opportunity to sell into those. Well, we're still long on WTI and miraculously still holding above this support level after 5 attempts to break down through there. Still haven't done that, and this level at $70 is holding pretty firm. We also know that OPEC has retained its voluntary output cuts for the moment, so that'll be putting a little bit of upward pressure on the price of oil. Going across to metals, well, we're long on gold, that looks okay. We're long on silver, that looks pretty good. Volumes will be a bit low today and light today across the board, really, because of the US holiday. And we're also long on uranium, and that has not opened yet. I expect we might just pull back on URA to complete filling this little gap here, and then we're looking for a continued move up to that trend line, and then beyond there up to this resistance level at around about 24.30, and then higher up into these higher resistance levels above us at around about 28.50, and then perhaps even into about $30. So that's uranium. And so far so good. So we're looking okay on the metals, we're looking okay on natural gas, and we're looking okay on oil. Just switching back to natural gas, remember we're looking for that wick low. So if you're in doubt and you're thinking of buying at these current levels, then wait for that wick low or spike low to form on this 4-hourly chart. And as it stands at the moment, it looks like there's a good chance of that forming at this next rollover. We're just holding above that 266 level. A tiny little wick low candle at the moment, but actually that's already starting to look quite positive. When it comes to stock and stock indices, I want to look at 4 things, and we'll have a look at the NASDAQ first. And I'm looking to sell into this pink level above us. We might just get a spike high, or we might form a double top here. I know it's all very bullish, and I know there's a lot of hype and a lot of FOMO going on, but at the same time, there are large funds and institutions who are reducing their long side exposure quite dramatically, and it may be that we'll see a top in the NASDAQ soon, either a double top here or a push up into this pink level, This pink level's formed by the 78.6% Fibonacci, and either side of that, we've got these important support and resistance levels. So this is a really important area of consolidation, support and resistance, and the 78.6% Fibonacci. We've rallied up over 45% from the low, and we've also reached the target area that I tweeted about in February this year. And again, if you have a look at Twitter, I put this post up a couple of days ago, and you can see this chart that I tweeted about, which I put up in February actually. We've pushed up to that level there at the top of this blue sort of zone at 15,200 and change. And I put a big exclamation mark on this, and this was in February earlier in the year. Everyone was telling me that I was ridiculous. There was no chance. Remember, the price was right down here when I posted this chart. Everyone was saying there's no chance for the price to rally back up to these sorts of highs where we are at the moment, actually right at this blue level. We got beyond these arrows and got even slightly higher up to this top of this blue level here. I think we had the most bearish sentiment in the market for a very, very long time, with the economy in peril and all sorts of indicators, including interest rate hikes, of course, which implied that the market wasn't going to rally much beyond this level here. And that was way down at 12,600. Now we're at 15,200, right at the top of this blue level. Everyone thought I was mad then when I said the market could go higher. And now everyone thinks I'm mad when I think the market could go lower, right at this level that I pointed out in February. So we'll have to see if that actually is going to be a turning point, just like it was 45% plus ago at the beginning of this year. We're right up over here now at the 786. Let's see what happens on NASDAQ. Really interesting chart. And the S&P is also interesting because we're at a key level right now. We're at this channel top, and we're also near this resistance level, starting at 4,460 and extending up into 4,540, this gray zone here. The top of this gray zone is also the 78.6% Fibonacci, and it's also these previous highs. But we've got this channel line to contend with. I think we might just spike up into that area, somewhere into this gray zone, and then begin to move down, at least for a short to medium term pullback, considering that both of these markets, all of these markets, are overhyped, overbought, overdone, overcooked, however you want to term it. The next one I want to look at is AMD, just an interesting observation. I did tweet about this again over here. You can have a look at where I've put this. I've actually drawn a little sort of graphic in here saying this is actually a repetition of what we saw just a few weeks ago with those three white soldier candles with an exhaustion candle at the top, followed by this bearish dark cloud cover candle. We're seeing exactly the same thing now, moving back and filling that gap on the left-hand side up to the top of that gap, the 20-period moving average, and this red resistance level formed by the bottom above the gap. And I've drawn in this little graphic, as I said, with a question mark above us. If we were to repeat what we saw a few weeks ago, we'd see this candle here, which I've done in gray, forming a dark cloud cover candle, taking us away from the top of this gap, back into the gap, and then potentially a move lower. So keep an eye on that for AMD. We'll have to see what happens. That's an interesting one. I also put a tweet up on Tesla, which is also a fascinating chart. Let's go across to the live charts to have a look at what this looks like on the live charts. There's no trading today because the markets are closed for Independence Day. However, the NASDAQ and the S&P are trading, and they're actually starting to come off just a little bit already. We'll have to wait until tomorrow to see how the individual stock names work out. Let's have a look at Tesla on the live charts. So here we have Tesla on the weekly chart. This is the picture I put up in the Twitter feed. I'm going to switch this to a daily chart just to have a look at what happened. And you can see after those fantastic production numbers that came out on Tesla, we gapped up. We formed this little candle here, not very convincing after the gap, just a nudge up higher, forming this tiny little daily wick. So not a lot of momentum after that gap up, and also not very much volume, as you can see at the bottom here. So for the last 1, 2, 3, 4, 5 days, 6 days maybe, we've seen a decrease in volume on Tesla despite this big move up. We are holding above the 20-period moving average on the daily chart quite nicely. We've got loads of gaps left behind. We've got that one there we've just formed. We've got another one down here, which was never closed. We've got another one down here, which was sort of partially closed. And we've got gaps all over the show on Tesla. So what are we going to see? Is this a blowout top, or is this the start of a new bull rally on Tesla? Most people think this is the start of a new bull rally, and it's Tesla to the moon. Of course, they would think that, being a meme stock, and it's Tesla, and there are all sorts of reasons to be buying Tesla. But we have a maniacal market going on, which is not being supported by the economic fundamentals. Let's have a look at it on the weekly chart. And this is what I think we might look forward to on Tesla moving forward. So I've drawn another pink zone in there. We've got these beautiful highs over here. We've got the 61.8% Fibonacci that we're just shy of at the moment. That's this blue line. And we've got these previous highs on the left-hand side going back to February 21, just poking up towards that 61.8%. So keep an eye out for Tesla. Watch out for a move higher, perhaps even another gap higher moving into the rest of this week, and a move into this zone here, and then look for exhaustion patterns and reversal candles on the daily chart for a move back down to, first of all, close this recent gap, and then perhaps close some of these daily gaps even further below us, starting with that one there, and then this one down here. So something like that on Tesla. We'll have to see the broader market weakening for all of these stocks to come off, but keep an eye out for that one. That's all I really want to say on stocks. However, let's just have a quick look at Apple, and this one's interesting. So we've got this very neat, all too beautiful trend line beneath us on Apple, and we just continue to move higher. We saw a gap up again over the last couple of days, and there are also a couple of gaps left behind us on Apple. There's one there that was never completely filled, there's one here, and there's one that we've just formed a couple of days ago. We're going to have to see Apple run out of steam and show some exhaustion before we see the broader market coming off, I think, because Apple makes up such a huge proportion of the S&P and the NASDAQ. But I just have a feeling that Apple is overcooked. We've literally got a straight line upwards with no retracements. We've got moving averages behind us that have left behind. I've just added the moving averages onto here. So here's the 20-period moving average, actually just tracking along this trend line. So we've got to get at least a pullback down to this trend line at some stage. But then look at the 50, the 100, and the 200-period moving averages and how far below us those are, how neat this trend line is, how overcooked this is. And if you just sort of squidge up your charts, you can see that this is almost a sort of a vertical rise, an incredibly steep upward trend. This is not going to be sustainable forever. Actually, arguably, you could take it right back to the beginning of the year, all the way down from 126. We're at 194 now. And since the bottom there, we've had one small pullback and then just this sort of rapid, massive rise higher. However, if we have a look at the broader view on this chart, there have been periods when Apple has tended just to keep on going up and up and up. This is not unprecedented. And if Apple manages to pull off one of these continued near vertical rises like we've seen on a few occasions before, that could drag up the S&P, the NASDAQ, and the entire stock market with it. But in the short term, I think we'll need to get some pullback, at least just a little bit, down to perhaps this trend line, the 20-period moving average, and then perhaps a gap fill of some of these small gaps that have been left behind. Very quickly on the Forex majors, and then I'm going to finish with this. We've got the Euro US dollar here. Have a look at one of my previous videos to see my thoughts on this. I have no clue. Either we're going to follow this red route for a move back down to 1.05, or we're going to follow the green route for a move up to 1.16. An enormous difference, and this information is of absolutely no use to you whatsoever. We could go up, or we could go down. At the moment, I'm completely ambivalent on the majors against the US dollar, and I've explained that in previous videos. Please have a look at some of those if you want to know why. Same applies to the pound US dollar. And then when it comes to the dollar yen and the euro yen, well, just having a look at these, we've seen some extra warnings coming from the Bank of Japan and the Japanese Ministry of Finance saying that 145 is really where they want to stop. There are threats and talks of intervention in selling the US dollar, buying Japanese yen to try and strengthen this. Their inflation rate's too high. They don't want their currency moving wildly and dramatically lower against the US dollar, and they're prepared to intervene. And they're also prepared to rope in some of the other economies like the US and Europe, perhaps Germany, perhaps France, the European Union, to aid them and assist them in strengthening their currency against the dollar. One interesting observation on here, if I switch this to the weekly chart, and I've taken a little bit of liberty here by cutting off the wick high here and cutting off the tiny wicks right at the bottom here in order to draw a Fibonacci retracement study. This is taking a little bit of liberty, but it's not actually unprecedented. When you're drawing Fibonacci's, a lot of people often only consider the candle bodies. This is not an unusual analysis technique. And if we do that and cut off that spike high, cut off these little wick lows at the bottom here, you can see that the dollar yen has retraced precisely 78.6% of the move from the top in October 22 down to the bottom in 2023, and that's the 78.6% Fibonacci retracement level that we've just knocked up against last week, and we tried again this week. And if we do fall back down from there, this weekly candle will have formed a tweezer top, and if we manage to get a bearish or a dark engulfing candle here, it will be a tweezer top with an engulfing candle, and that should see the dollar yen begin to move lower and drag all the other yen pairs down with it. Target for dollar yen is somewhere around about 130 yen to the dollar, and that's near the bottom that we saw in January 23, the beginning of this year. That's not an unrealistic target. It's a swing low which would become a natural price magnet, but it's also the target that many institutions, hedge funds, and banks have for the dollar yen moving into the rest of this year. In fact, I think there's a possibility that we could break this low at around 128 and move lower down into the 120 to 124 region, which would be somewhere around the natural resting place for this currency going back 20 or 30 or so years. Well, that's all, folks. That's your Independence Day update. I hope you've had a fantastic holiday for those of you in the US. And for those of you who are not in the US and who are busy trading, have a fantastic trading day. If you've enjoyed this content, please subscribe to the channel, press the like button, share it with your friends, share it with your enemies, and I'll speak to you in the next video. Take care.